Welcome to the Daily Bread. I'm your host, Tom Hartman, on this Thanksgiving Eve. It's Thanksgiving in the United States tomorrow, right? Yeah, never know. I'm a Canadian. Well, there's only two big stories that have happened over the last day when it comes to financial markets that I like to point out. This comes on the heels of yesterday's story, the little tidbit there of the Congressman Warren Davidson, who was floating the idea that taxes in the United States can be paid for with Bitcoin. They want your Bitcoin, folks, and they're going to find ways of getting it. In a little bit, we're going to take a look at the story of what's going on with MSTR and BlackRock's Bitcoin ETF, IBIT. But before we get to that, let's see the big story today, which was, well, the jobs numbers came out and it's mixed, right? Because this is not the big story here, but the jobs number came out and it was mixed. We've been having terrible jobs data, just revised lower. Issues with average hourly earnings, issues with inflation. Even though the rate of inflation is not increasing, inflation is still up. Prices are still up. They haven't come down significantly in any way. But then there was a U.S. jobless claims that came out this week, and Jim Bianco has a little thing to say about that. So now that the government is open, Bianco says on X, the data is flowing again. U.S. jobless claims 216,000 in November 22nd. Estimates 225,000. Sorry, U.S. jobless claims 216,000 in November. 22-week estimate 225,000. This is one of the lowest readings of the year. This is considered a desert island indicator. If needed one measure to tell you the health of the economy, it was initial claims. Now it doesn't fit the narrative that the labor market is falling apart and the Fed must keep cutting rates, so it gets ignored. Meanwhile, every financial television network today has run at least 3 stories about affordability, i.e. inflation, this morning. So let's make money cheaper, stimulate the economy, and pump the stock market higher. That will fix affordability. And this is true. This is a problem we are going to be seeing where the Trump administration wants to put money within the economy. This is what we know. This is what we're dealing with. And this is what we have to plan for when we're trading or investing right now. We might want it to be different, but this is what it is. Now, Jeff Snyder from Uredall University talks a little bit more about this, but from the other side. Most of the Treasury rejection narrative stems from a deep misunderstanding of curves, interest rates, and basic economics. The thing is, it sounds like it should happen. The government is broke. The debt problem is getting worse, but you need to understand that isn't a problem for the Treasury market. It's a massive problem for you and me. The bigger the government gets, it's a huge problem for the economy because the more Treasury borrows and Uncle Sam spends, the worse the economy performs. Government waste and inefficiency at best. And perversely, the more government fails at economics, the more demand there will be for Treasury assets. Again, this isn't the way we want to go, but you have to accept this is how the market and the monetary world works. This is what we keep saying here all the time. We just have to understand that this is the system, and you're not going to rail against the weather. This is what's going on. Treasury supply doesn't matter, and we have years and decades of proof showing you this. 2025 is another perfect example, especially since everyone said this was going to be the year Treasury supply did matter. Spoiler alert. Spoiler alert, nope, it didn't. The reason is depression economics, and that's the one key matter no one ever considers because they stupidly listen to the Fed and mainstream economics when both are upside down and backwards on reality. Right? So there's the idea here that the economy and financial markets are two separate things. Even though we like to think that they're saying, really, the financialization of the United States system and the Western world in general, but certainly the United States, causes money, capital, effort flow to go into financial markets and the economy, things that are not specifically investable by public markets or even private equity, gets shellacked, right? It's the Triffin's dilemma on steroids, where just naturally speaking, having the world reserve currency hollows out your middle class and then the poor, and then it eventually destroys the nation either economically or socially. At least that's the idea. So it's hard to say here. The certainly on the ground, it seems to be that things are bad for people, for the economy, but Jim Bianco makes the case here that at the very least, this one note that was given potentially good news is being ignored so that the Fed can cut. So all roads lead to the Fed cutting. But let's get back to what I want to talk about over here. This is from Stephen Marin. Remember, this is the guy on the board of governors for the Federal Reserve, who is essentially still working, not working really, sort of, with the Trump administration, and is largely considered to be a mouthpiece for the administration. Stephen says, my statement on the final rule of leverage ratio capital relief. I think we should give further attention to removal of Treasury securities and reserves from leverage ratio calculations, since we force banks to hold these through liquidity requirements. This is a big thing. You go take a look at the article online if you're interested in it. But the long and short is the TLDR is that there's a leverage calculation that's done with financial institutions, with banks, that require them to hold a certain amount of reserves of capital that they can't lend out. And so the reason for this is to avoid a global financial crisis type situation. And this restricts the amount of lending, amount of credit that can be issued, and thus diminishes the amount of money that can be created within the system, the amount of liquidity that could be created in the system. Remember, net dollars don't create more money. So if these financial institutions, these primary dealers, are forced to buy treasury securities to monetize the debt, they can't necessarily lend out the capital that they can't lend out as much as they would otherwise, because if they fall underneath the requirement, they get dinged by the powers that be. And so Stephen Marin here is floating the idea that, hey, the United States is forcing these financial institutions to buy treasury securities. And so if we remove that, still have them buy the treasury securities, but remove that from the leverage ratio calculations, this would allow them to lend more out, right? They could take on more risk because they're not constrained, which seems to fly in the face of, the whole reason of the SLR to begin with. But hey, this is what the administration, or not the administration, is saying. So things would look very different in 2027, 2028, if this sort of thing starts to take momentum. But this is right in line with what we've been saying. The government is looking for ways of getting more credit creation, getting more liquidity, and get more money within the financial system. Stock market go up, number go up. So that was interesting. A lot of people had takes on that. It's like, look, even though Hassett is looks to be, I think he's in 51-54% probability of being the next Fed chair. It's not decided yet, and regardless, the government seems to be taking control of the Federal Reserve and thus fiscal policy, so that you can have monetary policy supporting fiscal policy, and then you have all that controlled by the White House. This throws independence of the Fed right out, which is pretty interesting. El Arian had something to say about this recently, tangentially talking about the forward guidance about the Fed. So I want you to listen to this. It's very quick, but it's speaking more to the idea that the Fed is sort of like there's some volatility going on, and that we're seeing that volatility express itself in the beta markets and in the futures markets for Fed funds.
It's not just worrisome, it's crazy, Carl, and thanks for having me. In the last month, we've gone from over 90% in terms of expected rate cut to 30% back to 90%. That should not happen. The whole point of forward policy guidance is predictability and stability. And it matters not only for the US, but for the global system. And, when you had Secretary Bessent on your air yesterday, he's absolutely right. The Fed officials should not be involved in play-by-play analysis. They should be providing a strategic outlook that underpins the rates market, not makes it volatile.
And that's exactly right. That's the whole point of forward guidance. The whole point of forward guidance is that the Fed, instead of actually making the cuts or hikes or whatever it is, can forward guide that they will, and that the markets can reliably price that in now, so that we get the effects of those cuts or hikes or pauses now, instead of having to wait for the Fed to make their decision. The Fed doesn't want to come out and say anything at the pulpit, make any decision with their press meetings that is not what the market is pricing in. And so the very fact that there was such a volatility in the odds for this and how these futures markets were priced is belies the idea that the forward guidance one is working and that there's any stability to the prices there, to the expectations there. So he's right. And a lot of people feel the same way. It's like, what's going on? Well, what's going on is that they're trying to fight back against the loss of independence that they might experience if it's seen, one, that they're kowtowing to what Donald Trump and his administration wants for fiscal policy by supporting it with monetary policy, or two, flat out take over, right? Flat out that they're not just guiding policy, but they're actually completely in control of the Fed. And so in order to resist that, the forward guided, they left turn on the forward guiding, the reverse of the forward guiding, and it caused fluctuations within the markets. Well, that's not going to go because the main tool that the Fed has is forward guidance, not exactly rate cuts. All right, so we'll see what's going to happen there. We have a lull here for Thanksgiving, but we'll pick up on that next week. The last thing I want to point out here is this whole thing about MSTR and BlackRock. So there's a big conspiracy going on, right? Big kerfuffle, big conspiracy that the whole hubbub we've been hearing between JP Morgan and MSTR and MSCI, including crypto type assets inside of that index. There's ideas floating around that the reason all that started was to get visibility on IBIT. IBIT being the BlackRock Bitcoin ETF. So let's read a little bit about this. This comes from Jeff Park on X, who says, at last, IBIT options is finally getting the treatment it deserves. NASDAQ just filed to increase option limit to 1 million from 25,000 a year ago. Institutional vol is finally here. Happy Thanksgiving. And this is commented on by Peter Dewan, who says, he's a Bitcoin bull writer on X, who says, when Tom Lee told us that institutional investors were using MSTR options as hedges, the natural question was, why can't they hedge via IBIT options? The answer is NASDAQ only had 25,000 contracts available. Well, not anymore. NASDAQ increased IBIT options to 1 million contracts. This should have considerable impact on MSTR, as now that previous hedging pressure is transferred back to IBIT. So that might take the wind out of the sails for MSTR, and it might make it less of a desirable asset because it won't be the only girl on the block. There's other people to ask to the ball. Now, are they happy? Would BlackRock be happy with just being one of the ladies at the cotillion, or do they want to Nancy Kerrigan MSTR and IBIT be the big dog in town? We'll see. But it's interesting. That's it. The only other thing I wanted to mention is that the stock market completely recovered the drop from the what was this, October 10th was the drop? No, the drop from the NVIDIA earnings fiasco, where we had the negative gamma spiral to the downside. So that's over, and we're back up even higher than we were before that announcement, and we're drifting up. We'll see what happens more. We're going to take a look at that more as the weeks go on, because the negative gamma regime, the negative spirit bomb, is cooking up. It's in the works, and it's going to be used at a stock market near us one of these days real soon. That's it for me for November 26, 2025. You've been listening to the Daily Bread, and we'll be back maybe tomorrow. It's Thanksgiving, we'll see. Maybe tomorrow, maybe next week. Thanks, everyone.